Good morning and welcome to the Capital Gains in Canada and the U.S. Tax 101. I'm Warren Dueck and I'm in our Vancouver office. I'm joined by my colleague, Catherine Shen-Weafer.
Good morning.
Yeah,
everyone.
Good to have you here, Catherine. Catherine is a senior manager in our tax group, and we're going to talk about capital gains in Canada and the U.S. This is a really big topic, and there's a lot of nuance here. So, we're going to kind of identify the key issues, but there's always other issues in this subject. And given that our focus is on Canada and the U.S., we want to kind of contrast those two. Because one of the things we'll say here several times is that your goal as a taxpayer, if you're subject to tax in both countries because you're a U.S. citizen living in Canada, maybe you're a resident of the U.S. but have assets in Canada, your goal is not to reduce one tax, it's to reduce the overall tax. And so we're going to talk about that. Like I say, it is highly fact dependent. And why do people want to get capital gains? Well, that's because capital gains tax rates are lower than tax on ordinary income. And so that's the big attraction here. How can you get capital gains tax rates? Someone has said, and I've never tried to verify this, I don't want to try it to either, is that about half of the Income Tax Act in Canada and Canadian tax law and half of the Internal Revenue Code in the US and US tax law is all trying to prevent people from converting ordinary income into capital gains. Certainly there's more than a small amount of that. So it is significant trying to prevent people from doing that. But we'll talk about some of those issues. There are going to be questions here, so please submit your questions as we're going through the session. We'll talk about them on the back end. And there's also a survey we'll send to you after the webinar is over. And please, tell us what you thought. Other ideas for topics. This subject came out of someone who responded to the survey saying, hey, I'd really like to know more about this subject. So without further ado, we'll move ahead and we'll talk about capital gains. And the very first part of this is to define, what is a capital asset? Now, the U.S. talks in terms of capital asset. Canada talks about capital property. They both basically mean the same thing. And one of the interesting parts about Canadian U.S. tax law, this is one of those areas that actually gets very close convergence. You'll hear me say lots that, Canada and the U.S. are very similar, but it's the differences that count. In terms of capital gains and the definition of capital assets, capital property, there's a lot of similarity there, but recognize this is that most of the definition associated with what is a capital asset or what is capital property is not in the Internal Revenue Code or Income Tax Act of Canada. It's actually in case law. So Canada doesn't even have a definition of what capital property is in the Income Tax Act of Canada. The US has a little, but it's really not very descriptive. For example, in the definition of what a capital asset is, the US explicitly excludes inventory. So if you're a grocery store, you can't get capital gain treatment on the sale of your groceries. You might get it on the sale of property that is used in the business, but not the inventory part of it. Similarly, property sold in a business is not eligible for capital asset or capital property treatment. So that means if you're selling real estate, you can't get, if that's part of your business activity, you can't get that. But back to the grocery store example, they sell groceries. If they sold their building, yeah, they could get capital gain treatment. That's a little more obtuse discussion to get there, but we'll talk further about that later. Some examples of capital property and capital asset, and we'll use those terms interchangeably. Real property, but not if held for sale in the business. So if you're a developer and you're selling condos, you can't get capital gain treatment on that. But if you buy an apartment block and rent it out for a number of years and sell it, yeah, that could get capital gain treatment. And we're going to talk with a little more definition about what that means. Securities are generally are eligible as capital property. For the average investor, they aren't. For dealers or traders in securities, they're not. Another example of a capital property, assets acquired to earn income. So, if you buy a truck and strangely enough, it goes up in value, it may be a capital gain. Conversely, it can also be a capital loss in that respect too. And again, U.S. and tax law, the U.S. and Canadian tax law have some minor differences associated with how that's treated. We'll go on to that. Catherine, did you have any comments you wanted to add to that?
Yeah, that's essentially true. Under U.S. tax law, specifically for the item excluded from capital property are the inventory and the property sold in the business. And there are two essential requirements. One is the primarily for sale requirement, and also two, the customer's requirements. Now, both requirements are explained in the case law, and to make sure those requirements are met for not to be considered a capital asset. And also like a property used in held in a tradable business, or for used in a tradable business, like the asset acquired to earn income in the truck and then all that, is generally, if sold for gain, the gain is generally capital gain.
So we'll talk a little bit more about capital asset, capital property, specifically with respect to real estate. This is a source of a ton of tension on this subject as to what is a capital asset, what's not. And you can see by some of the factors that get looked here, there's not bright lines typically in terms of saying what exactly is it. It's easy to tell sometimes what it isn't. One of the primary factors, and Canada has a little more developed case law in this respect, is the idea of a primary and secondary intention. So if your primary intention is to buy real estate and then to subdivide it and sell it off as lots, that's not going to qualify as a capital asset or property. It will be treated as ordinary income when you make those sales. Conversely, if you bought the same piece of property, but you didn't subdivide it, and maybe you leased it out to a farmer to grow crops on for a number of years, and then sold it as one unit, it probably would be a capital asset, qualify for capital gain treatment. So you can see, we're talking about the same piece of property. So anything that involves subdivision, it doesn't necessarily mean you break it in two lots. You may still get capital gain treatment on that, but once you start developing into multiple lots or breaking it up and reselling it, it implies that there's a business activity here. And sometimes, and real estate is a particularly good example, because you don't buy it one day and sell it the next typically. Oftentimes real estate can be developed over a period of multiple years. And so oftentimes when land is bought, you're not sure how you're actually going to end up using it. You may buy it with the intention you're going to build a grocery store for your grocery business. But because of circumstances that happen over the course of years, you end up, building condos on it. And those both have different results. And so any good plan for real estate should consider all the available options, because, over time, you don't know what's going to happen. And particularly from my perspective as a tax person, you want to have an intention that says you might get capital gain treatment, because if you held the property and then sold it as one unit as opposed to subdividing it or building condos and selling off the condos, both of those things would create ordinary income. If you end up selling the property as a whole 5 years from now, you might get capital gain treatment of that where you don't subdivide or you don't build into smaller units. So this idea of primary and secondary intention are important here. Now, just to stop wishful thinking from controlling tax results, one of the criteria is also what's the feasibility of those intentions? In other words, is that even a practical result? The idea of maybe holding that property for a period of time. You know, if you're saying that it's zoned for condos, but you might build an apartment block and you know, to get capital gain treatment, you know, that may not be a feasible thing, and you know, zoning may affect that. You know, and despite your intentions, how did you respond to that? In other words, did you actually carry them out? You know, if you said, no, I want to sell this as a unit, but the only time and energy you spent was developing a business plan to build condos, which have been taxed as ordinary income, that'd be different. Another scenario, just to talk about this, is, you know, if you're going to build an apartment block and you sell it off as soon as it's finished, if you buy, develop and sell the property, you have more likelihood of getting ordinary income treatment. But if you built that same apartment block, leased it up and held it for 3 or 4 years, you have a much higher likelihood of getting capital gain treatment in that scenario. Again, this is highly fact dependent, so I can't give you a rule that says this works and this doesn't work. You know, another big question is, what's the taxpayer's business? If you're in the business of developing property, it's going to be difficult for you to get capital gain treatment associated with sales of real property. It's not necessarily impossible. I'd say Canada is tighter on this issue than necessarily the US is, but it's relevant. And you also have to think about who, if you have multiple people involved in it, is you say, well, I'm not a developer, but one of my associates involved in this project is, that may taint your interest as well. Financing terms, if the financing terms require you to, you know, build and sell, well, you know, that will also dictate potentially the treatment, whether it's a capital asset or not. The term of ownership, certainly the shorter the term you own the property, the more problems you're going to have with getting a capital asset, capital gain treatment. And other factors associated with the sale are relevant here too. So again, there's not one picture here, and you have to look at each time you acquire real property as to what are the alternatives. Can I get capital gain treatment out of this? Given that you get a very attractive tax rate from doing that, you always want to have the door open to that, because that may be the result, even though that's not the intention. Questions or comments, Catherine?
No, I'm good.
Okay, so another major property group is securities, and securities has a little more consistent result than real estate. Of course, you know, you can't subdivide, or it's difficult at least to subdivide shares of Google. You don't build condos on shares and things like that. And I would suggest to you some of these rules are, I'm going to say, historic. And the first one says, if you have extensive buying and selling of securities, you know, potentially this could result in ordinary income treatment, not in capital gain treatment. Now, there was a time where, you know, you paid an investment, a broker, you know, several $100s potentially to sell stock every time. So you limited your number of sales. Now these, you know, you can sell stock for almost pennies. And so there is more extensive buying and selling. There's certainly computer programs that do that. This alone does not make you into treatment as ordinary income. You could still have buy and sell, but other factors will be considered here too. For example, short periods of ownership. If you're a day trader, you're probably talking about ordinary income. The question, of course, is what distinguishes a day trader from an investor? And again, some of these other factors are relevant here. If you have experience in the securities market, I mean, if you're a former Goldman Sachs investment dealer, and you do extensive buying and selling, you have short periods of ownership, that may be challenging. You potentially could be a dealer, and any gains would be taxed as ordinary income. Where securities are part of your ordinary business, again, that's problematic too. I know we have a lot of investment advisors on this call. That doesn't necessarily mean that because it's securities or investment advice is part of your ordinary business, that necessarily it's going to get ordinary income treatment. But you need to be cautious about that subject. If you've invited offers to sell securities to him or her that said, hey, I'm always willing to buy your securities from you, that implies that, that's not a normal investment sort of activity. The other part is securities are speculative and do not pay dividends. I'm going to make this comparison between the apartment block we talked about and securities that pay dividends, because if you buy an apartment block and hold on to it for a series of years, you're getting a return of income on that. On the other hand, if you buy raw land and there's no return on it, or you buy securities and there's no dividends associated with it, that begs the question saying, what's the nature of the business activity, or is there a business activity here, and is it a capital gain? No single factor here is necessarily puts you offside, but you should be aware of that. So I'm going to pass this off to Catherine, and she's going to talk about tax rates and why capital gains rates matter.
Thanks, Warren. So when it comes to the differences between the two countries on tax rates, these are very important points here, because the mechanism of how these tax rates work or the capital gains are taxed are a little different. So for example, in Canada, so we see these capital gain tax rates are up to, 26.75% versus 53.5% in BC. Now that is because in Canada, so capital gain is taxed with at half, and that half is an inclusion rate of the capital gain recognized. So in that sense, that's where all other income is taxed at the graduate rate up to 53.5% in BC. Capital gains are taxed at half of that, which is up to 26.75%. And it's the same with Alberta and Ontario. So this is how Canada, the capital gains in Canada are taxed, and which are very different from how the capital gains are taxed in the U.S.
Just before you jump to the U.S. side, I mean, we talk about half the gain being taxed in Canada. That's where you get that. Obviously, the rate, for example, in Alberta is the capital gain rate's 24%, and the ordinary income top rate is 48%. But it wasn't that long ago, at least in my lifetime, maybe that says more about me, but that it was 2/3 of the capital gain was taxable, as opposed to just 50%. And so that rate would have jumped from being not 24%, but it would have been 32%. And so, this gets rumored every time a Canadian budget comes down that maybe that this rate would be changed. So there's nothing fixed about these except they're right now. That's exactly the case.
Yeah, I remember once there was a time that the inclusion rate was 3/4. Is that true, Warren?
3/4. Yes, thank you.
Yeah. So it has changed during the years. So, but recently, for quite a while, it has been 50%. So, in the U.S., there are preferential tax rates on certain income, like capital gains and qualified dividends. So, what it works is capital gains are taxed at a preferential tax rate up to 20%. Now this is under federal tax law, and we'll see here we have also versus 37%. Now that's because of the different types of taxpayers. So for any non-corporate taxpayers, the preferential capital gain tax rates are up to 20%. And more specific, it actually goes from 0%, 10%, 15% to 20%, depending on the taxpayer's income threshold and filing status. Now, so for corporate taxpayers, there's no preferential capital gain tax rate, and it is simply taxed at 37% marginal tax rate.
Well, just actually with corporations, of course, there's no preferential tax rate. It's 21%, the corporate tax rate.
Exactly right. And there are also other federal tax rates on the capital gains, and one of them is the unrecaptured gain that is taxed at 25%. Now we see that on the sale of real properties, and where there is a depreciation to be recaptured at the time of sale, and the maximum capital gain, maximum gain rate can be 25%, depending on the amount of the gain recognized. And also similar to the collectibles as well, that the rate can be up to 28% when there is a gain on the sale of collectibles in the U.S. And as Warren mentioned, there's no preferential capital gain rate for corporations. And since 2017, the Tax Cuts and Jobs Act, TCJA, now the U.S. corporate tax rate has been a flat rate of 21%. So in that case, corporations are taxed on all the income at 21%, including capital gains. So when it comes to states, there are no preferential capital gain tax rates that we're aware of. And generally speaking, the state tax rates range from 0 to 13.3%. Now that is from California. Depending on the income threshold that the person is at, and the gain will be also taxed within that range.
Yeah, so how does the state have a 0% tax rate? That sounds like a pretty good rate. That's referring actually to states that don't have an income tax. And those are places like, Alaska, Washington, Wyoming, Texas, Florida. For individuals, Florida doesn't have an income tax. So there's a big range there. And interestingly, the 13.3% rate in California, there's actually a proposal to raise that to 15.4%. Now, for those people in Canada who always think the US is tax nirvana, you're going to say, oh my goodness, if you pay 15.4% in California, and that raises your, add that with the federal tax to 37%, that means you're talking about a tax rate of 52.4%, an ordinary income tax rate. So, well, that feels pretty close to where, BC, for example, and Ontario are at. But remember that you only hit the top marginal rates in Canada, just over, in these two provinces, just over $200,000 Canadian. You hit that top rate in California at over $1 million US of taxable income. So that's a massive difference there.
Exactly right.
Go to the next slide.
Sure. Yeah, so how do you calculate the capital gains? So that is equal to proceeds minus adjusted cost basis. And again, that is the differences that matter when it comes to the details of in terms of holding period, carryover, and also including installment sale as well.
So, Catherine, just your computation. I mean, this is maybe the simple part, but it's also a part we should maybe talk about a little bit. So if I sell a house and someone pays me, $100,000, I get to deduct my cost, in purchasing that house. So if I bought the house for $60,000 and I sold it for $100,000, I'd have a $40,000 gain.
That's right.
And the $40,000 or the cost includes not only my cost of purchasing that house, but other costs I incurred to acquire it. So if I spent $1,000 with a lawyer to buy it, and I paid property transfer tax, and if I paid, some other fees, those will all get added on to that $60,000. And if I made any improvements to the property, I'd get to claim those costs too.
Yeah,
So,
that's exactly right.
yeah, so I get to reduce my gain by the improvements I've made. And this kind of brings up the big question saying, what's an improvement? Generally, if you put in a new bathroom and you put in new floors and shower and cabinets and things like that, that's an improvement. If you paint the walls, that's all you do, that's really not an improvement. That's actually just maintaining the property. But that's worth an analysis saying, what are the costs of acquiring it? So sorry, Catherine, go ahead.
No, that's exactly right, because that is the key concept or the key areas of what constitute an adjusted cost basis. No, that's great. Thanks. So yeah, when we look at Canada, so we in Canada do not have a holding period requirement for calculating capital gain and loss tax purposes. So it doesn't matter whether you hold a property or capital asset for 3 months or versus 10 years, the capital, it does not affect the calculation of capital gains and losses.
So as long as it's a capital asset, when I sell it, or a capital property for Canadian purposes, but if I sell the property, I don't have to hold it for a minimum period of time.
That's correct.
But in the US, I do.
Because there is a preferential tax rate here.
So I
So
only get that 20% tax rate if I hold it for at least a year.
More than a year. So yeah, so it's inclusive in the less than and equal to 1 year. That's short term, which is taxed at the ordinary rate, a maximum of 37%. So yeah, I'd like to look at Canada first here. So when you sell a property and then it incurs a loss, and in Canada, the capital loss carryover can be back to 3 years, where you carry back the loss to one of the 3 preceding years, where you have a capital gain to apply to, so that you can reduce the capital gain tax paid in that year, or you can carry forward the loss unlimited indefinitely. And in contrast to the US rules here, it's much simpler. Basically, the capital loss carryover can be just unlimited indefinitely. Any comments here, Warren?
None of that part. I think the installment sale is one of the interesting things here.
Okay. So yeah, and so installment sale. So what that is that taxpayer gets to recognize capital gains periodically, like each year after the transaction. So in Canada, there is generally a maximum year of 5 years to allow taxpayer to defer the capital gain recognized from the transaction.
No, Catherine, just on that point though, tax law says you have a maximum of 5 years, but you can make an installment sale for any period of time you want. But for tax purposes, you have to recognize all the gain in 5 years. So if you make a 20-year installment sale in Canada, you've got to recognize that gain within 5 years. You still haven't got paid. You may be paying tax on money you haven't received yet.
Yeah.
So, then you need to be really careful about that 5-year period.
Sure. And this is quite different when you compare to the installment sale in the US, which allows a little bit more flexibility as to one, the maximum selling price, two, the fixed period, whether there is a fixed period or whether there's no fixed period. Generally speaking, there's no limit on the number of years for the gain to be recognized, unless there's a special rule here, unless the price is uncertain or there's no maximum selling price. So a lot of flexibility in the U.S. tax system in terms of installment sale. And as to gain recognition every year, it is calculated as the gross profit times the amount received every year. So you basically recognize the gain kind of periodically every single year in a fixed period of time. Generally, in practice, I've seen is 5 years as well, but that is different from the 5-year maximum rule in Canada. So, yeah.
Now, remember, I just want to remind our audience here that you can have any term you want in an installment sale, but for tax purposes, there's going to be a different result. And what I want to warn people about is particularly Canadians investing in typically U.S. real estate, and they sell it on an installment sale. And it's not uncommon to see a term of 10 years or 20 years. Basically, you're financing the sale of that property. And you can choose any term you want, and the U.S. is fine with that from a tax perspective. But remember that if you're a resident of Canada and you're selling U.S. real property, you're subject to tax in the U.S. in that sale, but you're also subject to tax in Canada. And if you have a 20-year installment sale that you pay U.S. tax over 20 years, you're still paying your Canadian tax in 5 years. So this is a disaster waiting to happen when you use an installment sale and you're not matching Canadian U.S. tax law, because again, while they're very similar on capital gains, or definition of capital property, this is a subject they're different on. And that's the reverse is true when you talk about long-term gain versus short-term gain. Short-term capital gains in the U.S. are subject to tax at rates up to 37%, but long-term gains are at 20%. So if you can sell your shares in 364 days or in 366 days, hold on to them for 2 extra days and get that long-term capital gain treatment.
Exactly right. Shall we move on to the next slide?
Sure.
Thanks. Okay, so it's best illustrated with an example here, a simple example here. So the Canadian resident sells shares of Suncor. So the taxpayer bought it for $10 and sold 8 months later for $110. So how much tax, Canadian tax, is the taxpayer paying? Now that is calculated as, again, proceeds minus the cost basis times the tax rate we just discussed. And in this example will be a BC resident. And so the taxpayer is paying $27 on the capital gain recognized in this transaction. Now let's add a little bit of complexity there, saying same facts there above, except that the taxpayer is also a U.S. citizen resident in Canada. Now, how does that work? So the taxpayer, since he is a resident of Canada and he is taxed on the worldwide income, of course, including the capital gain. So the taxpayer still pays $27 of the capital gain on this transaction. At the same time, because he is a U.S. citizen and so on, his worldwide income is taxed in the U.S. as well. And he would also have to calculate the capital gain realized. And in this case, the difference is that because the holding period is only 8 months, now that is less than 1 year. So that shows that this is a short-term capital gain. And therefore, it's taxed at an ordinary tax rate. And supposing this taxpayer is at the maximum marginal tax rate, so it gives the 37% tax rate to be applied on the gain. Now, and so the tax is higher. However, since he is a resident of Canada and the tax is paid in Canada first, first because he is sourced to Canada, and there is a foreign tax credit available to the taxpayer. So here is that the application of the $27 being applied to the US tax, so that it's not double taxed. Double taxation is eliminated here through the application of foreign tax credit, and so on. So the taxpayer, I think the entire tax paid is $27. More comments here?
37.
Oh, 37. I'm sorry.
Yeah.
So yeah, exactly.
27 to Canada and 10 to the US.
Yes.
You know, it's you're always getting hit by both parties here if you're a U.S. citizen resident in Canada, and or if you're a U.S. citizen residing anywhere, is you have to pay both the domestic tax and also your U.S. tax.
That's right.
And if they held these shares for more than 12 months, this U.S. tax would have been eliminated, because the U.S. tax rate of 37% would have gone down to, I'm not very good with numbers here, but it would have gone down to a 20% tax rate for a long-term capital gain, and the foreign tax credits would have eliminated 100% of the U.S. tax. So, you know, that potentially makes a big difference there. Now, we're tax advisors, not investment advisors. And if you have, by holding onto the property for the shares for another 4 months, the shares went down from $110 to $1.10. You know, you'd lose. There'd be no gain to worry about. So, you know, investment decisions always come first. Tax decisions are secondary.
Exactly right. And there will be, in this case, if it was a long-term capital gain, there will be a foreign tax credit carryover to next year, because it's, is that right, Warren? So, yeah. And in the US, it can be carried forward for 10 years. So, yeah,
Canada has much more restrictive foreign tax credit rules. The US allows you a 1-year carry back and 10-year forward.
Exactly.
So, we ready to move to the next slide?
Sure.
So, we're talking about sourcing here.
Yeah.
And do you want to talk about that? Or you want me to talk?
Oh, no, you can go ahead.
Okay. The sourcing rules says, well, who gets to tax the gain first? Because when you have two countries, I mean, people always think, especially for U.S. citizens resident in Canada and other countries, is they're being double taxed. Yes, they are being taxed by two countries, but generally, wherever they pay tax first, they can claim as a credit against the tax of the other country. So the big question for countries is always, who gets to tax things first? And generally, it's taxed first to the country of residence. In other words, if you own shares of Apple or IBM and you live in Canada, Canada gets to tax them first. And the treaty and other provisions generally prevent, the US does not tax non-resident aliens on gains of securities. A big exception here is real property. Generally, it's taxed first in the country where the real property is located. So if you own US real property, the US gets taxed first. When you own Mexican real property, Mexico gets taxed first. I wouldn't want to say that's the rule everywhere, but it's almost universal in certainly the developed world. As I noted below there, you know, US citizens resident in Canada, they're taxed on worldwide income, both US and Canada. You know, the gain is sourced generally to the country of residence, which maybe Canada and US taxes the gain too, but then gives that foreign tax credit for the tax paid. So next we're going to give you a quiz. It's quiz time here now. And that means we're testing the audience. It's a kind of recall thing. We want to make sure everybody's in tune. And, you know, I wish I could give you a button to push or something like that, but you can do this on your own. So if there's a sale of Apple shares by a resident of Canada, what's the source of that income? It's a US company, and Apple's a US company. So what's the source of that income? Catherine, you want to take a shot at that one?
Absolutely. So depends on the residency of the taxpayer. So if the taxpayer is a resident of Canada, let's say the gain recognized on this transaction will be sourced to Canada.
Yeah, and that's right. The US actually says it won't tax at all. And it doesn't matter whether you own, you know, 0.0001% of Apple, or if you own 20% of Apple or 50% of Apple, it would not be subject to US tax unless you're a US citizen. That's an exception. But if you're a Canadian person, not a US citizen, and you live in Canada, the US says it won't tax that transaction, even though it's a US company. This has come up before Congress, before some members of Congress want to have non-US people subject to US tax and sale of US companies. But it really creates a problem because it destroys capital markets. People would be reluctant to invest in Apple shares. So let's move on to the next example. It's same as number one, but the shares are held by a US brokerage. So, you know, if we're talking about a Canadian resident here, the answer is the same as number one, is that it doesn't matter that it's held by a US brokerage. It's still subject to tax only in Canada if they're a Canadian resident. If they're a Canadian resident, but also US citizen, Canada taxes it first and the US taxes it second. Number three, it's the same facts as number one, sale of Apple shares, but shares are held by a British brokerage. The answer is the same as number one. It doesn't matter where the brokerage is located. It matters where the individual shareholder is resident. If they're a resident of Canada, they pay Canadian tax only. They're not subject to US tax. The exception there is whether they're a US citizen. So number four, the sale of US real property. Again, we're going to do this. I should have put this in the notes here, but it's by a Canadian resident. What's the source of that income and who gets the tax first? Catherine.
Well, since real property is an exception to the sourcing of capital gains, so in this case, it is a US source for Canadian taxpayers, and it is taxed in the US first. And Canadian resident can claim a foreign tax credit on the gain recognized in Canada.
Yeah, it actually doesn't matter where the individual is resident, whether they're a resident of Canada, whether they're a resident of Hong Kong, whether they're a resident of France. The US and similarly Canada always retains the right to tax its real property. That may not be a surprising concept, but actually this has been a real source of problem for the US. And while we're not going to talk about it today, there is a fairly substantial piece of law in the US referred to as FIRPTA, or the Foreign Investment Real Property Tax Act, that deals with this subject to make sure that people pay US tax on sales of US real property. So what about sale of shares of a US real property holding company? We said above, if we sold shares of Apple, it wouldn't be subject to US tax. But if a Canadian sells shares of a US real property holding company, is it subject to US tax? Catherine?
That is a tricky one because a US real property holding corporation is a corporation where the more than 50% of the fair market value is on the US real property interest. And so since US real property interest is a US source, and therefore the sale of shares of US real property holding corporation, I would say the gain will be sourced to the US.
Yeah, number 4 and 5 are both impacted by this Foreign Investment Real Property Tax Act, a U.S. tax law. And Canada has a similar concept here that if you incorporate real property, if you have a real property in a corporation that's more than 50% of the assets, it is considered to be a U.S. real property holding company. Now, you have to be careful here because the definition is fairly expansive. And so companies just say, well, they're not a real property holding company. They're an oil and gas company, or they're a mining company. They can also be U.S. real property holding companies because more than 50% of their assets is from real property. And real property includes natural resources that are still in the ground. And again, Canada has a similar rule to this too, that says if you've got shares of a Canadian corporation where more than 50% of its assets are Canadian real property, including, minerals in the ground and oil in the ground, it's going to be subject to tax in that jurisdiction. Okay, we're still on this one. It's the same as number 5, but the company's publicly traded. So here's an interesting one. There's actually an exception here that under the rules of FIRPTA actually exclude publicly traded companies from that rule, but privately held companies are not exempt from that rule. Sale of software code for VisiCalc. Now I'm showing my age here. VisiCalc was a predecessor. I'm going to say that was in probably that was like mid 80s. I think VisiCalc was out, and it was kind of the Excel spreadsheet at the time. But so what's the source of that if it's sold?
So that will be an IP.
What's IP?
Intellectual property.
Okay, yeah.
So intellectual property has some complex rules, as I'm aware of. Generally speaking, I would say still goes with in Canada, goes with the residency of the taxpayer.
That's right.
Where
so think about it this way. Software code is an intangible asset, but so is Apple shares. They're an intangible asset. There's no value associated with that little piece of paper that says Apple on it. And that may have trains running across it or some planes or something like that. Those are intangible assets, and so is the software code for VisiCalc. And if I sold it, the issue would be is where do I reside?
Okay. So
sale of a hot dog stand in the U.S. by a resident of Canada. So a hot dog stand would be used. There'd be a business of selling hot dogs, and it's not intangible property. It's tangible property, and it was used in a business. And even though the individual resident in Canada, it would be subject to U.S. tax on the sale of that property. So this, sourcing rules are really quite fascinating and not well understood. I think the things that are obvious here are when you sell intangible assets, it's the country of residence that generally gets primary taxing authority. So if you're a resident of Canada and you sell your shares of Apple, it's taxed by Canada. If you sell real estate and it's in another country, that other country generally has taxing authority on it. Canada will tax that gain though too, and we'll give an example later on that subject. So Catherine, do you want to talk a little bit more about real estate? And I said sale.
Oh, there's one. Okay.
Sale of partnership interest with the U.S. business.
Okay, so this one also is an interesting one. I would say before the Grecian case in 2017. Generally,
that sounds like something. That sounds like something men put on their hair.
That's a tax court case. I think came out in 2017. And before that case, generally speaking, it was the sale of partnership interest. Was a capital gain, and based on the revenue proc. And after that case, and it adopted the aggregate approach, which is to look at the partnership assets. So this can result in the capital gain recognized on the sale of partnership assets, and I think that was later on codified in the A64C8.
So let's just compare this to what we've already learned. We said intangible assets are sourced to the country of residence. And an interest in a partnership is an intangible asset. But in this case, and U.S. tax law specifically is saying, if it conducted a U.S. business, that sale, that partnership interest is subject to U.S. tax first, even if the seller is resident in Canada. And so this is an exception to that rule. Partnerships by their nature have some uncertainty associated with how does tax law treat the entity? Does it treat it as an aggregation of interests, or does it treat it as a separate entity by itself? So yeah, there's an unusual result there. We'll go on to the next slide here with real estate and securities. You want to go ahead, Catherine?
Sure, yeah. So when it comes to real estate and securities, when you're comparing the rules of two countries here, so both would realize capital gains in any sales for a gain if it's not in the real estate development industry. And there would also be a recapture of tax depreciation in Canada and the U.S. with a similar mechanism of recognizing such income as ordinary. What is different is on the alternative minimum tax. So in Canada, the minimum tax applies to all taxpayers, and what that is to so for taxpayers, if their minimum tax is higher than the regular tax calculated in the usual way, then you will have to pay this minimum tax. The intention is to avoid any or exclude any tax incentives for certain taxpayers with a certain income threshold. When it compares to the alternative minimum tax in the U.S., so after 2017 TCJA, I think it only now applies to non-corporate taxpayers, where the corporations are no longer subject to alternative minimum tax in the U.S. And when it comes to, so non-corporate taxpayers also include the shareholders or partners of S corporation or partnership that the minimum tax is applied on. And there is also a set of rules in the U.S. that specifically on the property used in business, which is the Section 1231 property, generally speaking. So the gains would be treated as capital gains, where the losses are treated as ordinary losses, which are very preferential and beneficial for taxpayers, because taxpayers get the best of both worlds, where the gain is taxed at a preferential tax rate, where the losses can be applied to just any losses because it's ordinary loss. More comments on 1231, Warren?
No, 1231 in the U.S. is a real boon. You know, if you buy some real estate that goes up in value and it's used in your business, you know, this is the grocery store that sells its store, it gets capital gain treatment. In a corporation, that doesn't mean a whole lot, but a lot of U.S. businesses are formed in a partnership sort of structure, including LLCs. You know, gains are treated as capital gains. But the big thing is that losses are ordinary. So that, you know, that truck you buy to haul the groceries, when you sell it and end up with a loss on it, they're ordinary losses. So that's a big win for businesses in the U.S. Canada doesn't have an equivalent there.
Absolutely. And also, what's different from Canada is that there is a estate and gift tax system regime in the U.S. And for real properties, U.S. real properties and U.S. securities, both are U.S. situs assets subject to the estate and gift tax purposes. So, and these are also the factors that taxpayers need to consider, especially when they're doing tax planning of involving these properties and assets.
Yeah.
Warren, more comments on that?
No, I think that's, I mean, that's not a capital gain question, but this may form, you know, what sort of structure you're going to use to do things. So that's a relevant issue there. Great, we'll go on to an example here. And if a U.S. real property sale by a Canadian resident, we get a lot of these questions here. So we'll just walk through this saying, you know, you sell the property in 2022, you bought it in 2011. When you talk about gains for U.S. tax purposes, you sold it for $500, you bought it for $400, there's a $100,000 gain. Some people think that then you take that gain and convert it to Canadian dollars. No. You've got to actually convert it at historic exchange rates. So when you sell it at an 80% exchange rate or 80 cents on the dollar, that 500,000 becomes 625,000. When you purchased it back in 2011, the exchange rate was 211. The Canadian dollar cost was less than the US dollar. So you don't have a $120,000 gain, you've got a $261,000 gain. It's a massive gain. Now, remember, it's real property, so the US tax has to come first because it's US real property. So the US tax would be, you know, $20,000, 20% on $100,000. But I have to convert that back to Canadian dollars then. I'm going to pay this amount. I'm going to pay the 20,000 US to the US government, but I've got to convert it back to Canadian dollars so I can claim a foreign tax credit in Canada. My Canadian tax using BC rates is about $70,000. But I've already paid US tax at 25. I get to claim that as a foreign tax credit. So my Canadian tax is 45, my US tax is 25, and I pay a total tax of 70,000 Canadian. Now, just to show you why exchange rates are so important, if I flip these rates around and said when I sold it in 2022, my exchange rate was $1.10, and when I bought it in 2011, it was 80 cents. Even though I have a US dollar gain, I'd have a Canadian dollar loss. And Canadian tax is always computed in Canadian dollars. I don't care whether you did the transaction in euros, in rupiahs, in whatever currency you want. It's always converted into Canadian dollars. That's also true for US purposes. It's converted in US dollars. And the exchange rate is the historic exchange rate. If you made improvements on the property, you use the exchange rate in the year you made the improvements. So this is just a simple calculation that shows what your total tax should be. Of course, we use the top marginal rates here. We didn't try and use the graduated rates, and that would have an impact on the actual tax here in both Canada and the US. So that's our Canadian tax and US tax on the US real property sale by a Canadian resident. And this answer would be the same whether that Canadian resident is a US citizen resident in Canada or not a US citizen resident in Canada. Any comments here, Catherine?
No, it's just the tax that taxpayer pays in the country with a higher rate. So because the total tax is 70,000, which is exactly what the Canadian tax is.
Yeah. And we've got one more slide, and I'm gonna let Catherine go through that. It's 10 o'clock pretty much as we speak here. So You're welcome to stay with us. We're going to take questions after this. We'll spend about maybe 5-10 minutes doing that.
Okay.
If you're not able to stay with us, please complete the survey. We value your input and look forward to meeting with you again. Go ahead, Catherine.
Sure. So there is a great tax incentive in both countries on capital gain exemption for small business. So in Canada, it's called the Qualified Small Business Corporation shares. So what happens is that if a qualified small business corporation is the requirement is met and the taxpayer sells the shares in this corporation, and with all those requirements being met, like the 50% of assets used in the active business in Canada, and a holding period of 24 months is met as well, then the taxpayer can exclude about $913,000 in some capital gain from the transaction, so which is very beneficial for client and for taxpayers. So this number actually is indexed every year, I believe, and this is 2022, the exemption amount. So however, there is a caution or special rule on that, which is that where the taxpayer is a U.S. citizen or resident of Canada, and the gain has a chance to be resourced to U.S. if the Canadian tax rate is less than 10% at the end on the transaction. So, and the gain will be resourced to the U.S. and foreign tax credit may not be available in this scenario. Have you ever seen such an example in real life in practice, Warren?
Yeah, well, and this rule, remember, this rule only applies to U.S. citizens resident of Canada. It doesn't apply to, it wouldn't impact Canadians who are not U.S. persons, but it would affect U.S. citizens resident of Canada and people who are, U.S. residents. Perhaps they have a green card and they live in Canada. They're a U.S. resident for U.S. tax purposes. So yeah, it does affect them. The goal here is not to eliminate your Canadian tax if you're a U.S. citizen. It's to reduce your overall tax. And if you reduce the Canadian tax below a 10% tax rate, then you end up in a situation, you still got to pay the U.S. tax anyways, but you may also lose the benefit of foreign tax credits that may be available to you. So it's always, how do you find the lowest overall tax? Not the lowest tax in Canada, not the lowest tax in the US, but the lowest overall tax. That's really the secret of good tax planning.
That is right. So now when it comes to the US, in the US, there's qualified small business shares that is specifically on US domestic C corporation. And the assets, the gross assets held by the corporation have to be less than 50 million when the shares are sold. And also there are requirements on certain businesses. So it has to be a qualified trade or business. So, and some exceptions include like services, like attorney, accountants, engineers, firms, and also real estate businesses. Those are excluded. So how that works is that when the taxpayer sells the shares, the stock of the qualified small business, they can exclude the greater of the two. One is the $10 million and the other is the 10 times the tax basis of the share. So for example, if a taxpayer has a cost basis of the qualified small business for 3 million and later on sells it for 33 million, and the gain recognized will be 30 million. So based on the rule here, so the greater of 10 million versus and the 10 times tax basis would be 30 million, because the 3 million will be timed 10 times. That is exactly 30 million. And so on, the taxpayer can exclude in the entire 30 million capital gain from this transaction. This rule is very popular in the US, especially in any tax planning involving and preserving the qualification of qualified small business stock. So.
Yeah, so these are both great opportunities, but they're also mutually exclusive. In order to qualify in the US, it has to be a domestic C corporation. That's a corporation formed in the US. In Canada, well, it's not very explicit. A CCPC, or Canadian Controlled Private Corporation, is a corporation formed in Canada. So I don't want to say it's impossible, but they are mutually exclusive. There can be some very unusual circumstances to have one qualifying or both of these. I don't want to say that's necessarily impossible, but it's pretty close to that. I also want to just draw attention to, Catherine, your comment on excluded business. There isn't a specific requirement like the US one on excluded business that says that certain businesses don't qualify, but lots of businesses will not meet this threshold. I know we've got a bunch of investment advisors online, and if they're a US person, or excuse me, if they're trying to qualify for this and they've incorporated their services, more than 50% of their assets won't be used in an active business, nor will other professionals like lawyers and accountants and engineers and doctors, because my business requires me to have a computer and some monitors and some minor amounts of furniture, but generally that's a fraction of the assets in my business, because the other ones are investments that I've made from fees that have been earned. So incorporated professionals generally will not qualify for this treatment. Other comments, Catherine?
Yeah, no, that's exactly true, because the requirement is really on the business assets, cannot be the expertise or skills of the employees of the business. So that's exactly why.
Okay.
Yeah.
Well, that concludes our presentation, but we're going to go to the most fun part here, is questions and completing the survey. And we've got one of our colleagues, Shan Liu, and she's helped by Gina Min. They're both in our tax groups, and they've got some questions for us. Shan, what do you got for us?
Yes, we received quite a bit of questions, and also thank you for the audience who participated in our quiz section, actually. Yeah, so the first question, this question comes up when we talk about factors to determine capital gains versus ordinary income. What happens if you have a dual intent? Is there an allocation of the value?
No, I mean, it's going to basically find that it's either a capital gain or not. I mean, if you have a dual intent, but you actually end up developing into condos and selling the condos, it's going to get ordinary income treatment. If you have a dual intent and your first thought is you're going to build it for condos, but you actually end up selling it as a single unit, as a parcel of land, because not subdivided, not built into separate units, you may have potential for capital gain treatment. That is much more difficult for a developer to do, particularly in Canada. Canada has tighter rules on that subject than it necessarily is in the US. I don't want to say that you get a carte blanche treatment, but the US will tend to look more at the specific facts associated with the development with that parcel than otherwise. So, I think the smart person, the well-advised person should always look with dual intent, saying, something, I'm buying this property to, build condos and sell them off and get ordinary income tax treatment. But, if the day after I buy the property, someone comes up to me and says, I want to buy this property from you for triple the purchase price, you may have an option to get into the capital gain space. Again, this is very fact specific. So
Thank you, Warren. So the next question is, maybe we can give some examples, explain and give some examples of recaptured gain and collectibles.
well, collectibles, what fits in a collectibles? If you've got a stamp collection,
Coins,
coins.
precious metals. Yeah.
Yeah, well, would precious metals actually fit into, are they actually collectibles? Maybe they are.
Yeah. Yeah.
Okay.
Antiques.
Antiques, yeah, things like that would fit. Baseball cards, trading, baseball season now. So yeah, things like that would be collectibles. And what was the other?
The recapture. The
Oh, the
recapture.
recapture.
Yeah.
So Canada has recapture, and both Canada and the US have a recapture of depreciation. The US has a special rule that only applies to individuals, and that includes where they own interest in real estate through partnerships and things like that. There can be a recapture. That's where depreciation has been claimed in year 1 and 2 and 3 and 4. The property is sold in year 5, and to the extent the gain exceeds the depreciated cost, part of that gain is recaptured and is subject to a higher tax rate than would otherwise apply. And Canada has a similar rule. There's some details there that are different associated with each.
Thanks. So the other question we have is, for example, if I purchase 100 shares in Apple prior to move to Canada and purchase another 100 shares in Apple after move to Canada, and then later on I sell 100 shares, how is the basis determined?
Hey, that is a great question. That's actually that is maybe a subject we avoid in this, but there's a huge opportunity there. So the interesting thing about the shares acquired pre-move, I mean, in either case, where they're sold when the individual is resident in Canada, they're taxable in Canada first. And if we're talking about someone who's only a Canadian resident and not a US citizen, Canada is only going to tax any appreciation of the Apple shares after the individual came to Canada. So the 100 shares he bought before, he will not pay Canadian tax on any appreciation prior to coming to Canada. In certain circumstances, he won't pay any US tax on those shares either, because he's a Canadian resident when he actually sells them. Now, the gain, Canada basically has an average costing provision which says it doesn't matter which 100 shares you sell, you take the average cost. But the average cost of the shares that he bought after he came to Canada is whatever the price he paid was. But the average cost of shares for Canadian tax purposes of the shares he bought before coming to Canada is not the cash he paid when he was not in Canada. It's the fair market value of those shares when he returned to Canada. So if he returned on, October 1st, 2021, it'd be the fair market value of those shares at that date. And you'd use those two amounts, the purchase price of the post-move shares and the fair market value on the date of move of the pre-move shares, and you combine them to say what your average cost is. It's a great question. There's also a great opportunity there too. If I went down to Apple and they gave me shares when they were pennies on the a piece, and then I came back to Canada and they went public and they went from being worth a penny to being worth, $1,000 a share. I would not pay US tax on that $1,000 appreciation, and I would only pay Canadian tax on appreciation after I came to Canada. So there's potentially a massive win. Canada's a tax haven that nobody talks about. Canadians don't even realize that. So yeah, there's an opportunity there.
Are we still okay to take more questions?
Well, let's take it's 10:14. Let's take one more question. Does that sound okay, Shan?
Yeah, perfect. So the last one will be the U.S. capital gain tax on real estate is waived up to $500,000 for joint taxpayer if you have as a primary residency. How is it calculated in Canada?
Well, there's yeah, up to $500,000 is waived on a principal residence for U.S. tax purposes. Canada does not tax principal residences at all, and even if they're in the U.S. So this becomes a little more complex question. But so let's say someone's moving from California to Calgary, and they've got a you know, they have a $500,000 gain on the sale on that would arise from the sale of their property, but they own it when they come to Canada. They don't sell it until after that. For Canadian tax purposes, the Canadian tax base is that property is not their cost. It's the fair market value when they move to Canada. So if they move to Canada and sell it the next day, you'd say their fair market value is equal to their cost, the selling price, and there'd be no Canadian tax gain. There's similarly, there'd be a gain in the U.S., but up to $500,000 is excluded in that. Did we get that question answered, Shan?
That's correct. That's perfect. Thanks, Warren.
Okay. Well, thank you, Shan and Catherine, and there's some people behind the scenes. Gina is here, and we've got other people putting this together. Thank you for your help on this, and thank you to our audience. Appreciate you participating and asking questions and joining us. And please do complete the survey. We're interested in what you say and ways we can make this better and clearer, and look forward to meeting up with you again. Thanks very much.
Thank you.